Bob, we are talking about gates, mechanisms that keep investors from pulling their money out of hedge funds, which we discussed a lot in 2008 when people really wanted their money at that moment and couldn't get them out.
And the gates came down.
That's right.
So there are two kinds of gates, and it actually makes a big difference which kind of gate the hedge fund that you're investing in has. One is a fund level gate, so that if usually 25% of the people kind of run for the exits at the same moment, the gates come down and that's it. The other one is an individual level gate, so that after your lockup expires, which is usually a year, even then you can only draw your money out 25% at a time, so usually 25% per quarter for another year.
Okay, we understand, or at least I understand, why a hedge fund manager would want the gates around, because it gives that person more control and you don't have these literal runs on the bank for a fund, which can affect, I'm sure, the positions that he or she are taking. But what is the general rationale? Why does the ecosystem permit gates?
Well, the argument is that's what the investment manager wants, but the question is, why does he want it? I mean, obviously he wants to keep the money.
It's easier.
Yes. Well, what he will tell you, and what the managers will tell you, is, wait a minute, but if all the money leaves at the wrong time, I'm going to have to break trades in the middle at extremely unfavorable times, and that's bad for the investors. So it's in the investors' best interest as well to have these gates. Now, that's a pretty good argument for some kinds of strategies, but if you're running a completely liquid long-short strategy as a manager, you probably can get out of that, very, very quickly without a lot of damage. On the other hand, if you're running a distressed credit fund where you're buying something and you have to work the credit for a year to get the value, then if everybody leaves at the same time, you may well have to sell at exactly the wrong moment.
Okay, so the strategy is to consider what else?
When you get in, you want to look at whether it's a fund level or an individual level. And the reason is this. The fund level gates actually have a bizarre kind of game theory unintended consequence to them, which is this. If you're an investor in a fund like that and you know only the first 25% get out, the first hint of trouble, what happens? Everybody simultaneously dashes for the exit. And so it really it's exactly the opposite. Instead of controlling the exodus, it actually creates an exodus.
All right, which is pretty much the opposite of the intended effects.
Precisely.